Welcome back, Greg Silverman here, Chief Investment Officer. Just having a look at this. Caleb Thomas does a great piece every week. He calls the S&P 500 ChartStorm, and this is for 21 August. So it's about 3 weeks old, but still, nonetheless, always good to go back and see what was said and what transpired. So this is kind of skim through this. These charts focus on the S&P 500. I'm not going to read it to you like I normally do. Welcome to the new lower highs, or the making of a lower high. Failure at the 200-day moving average. I love charts. I don't know about you guys. Failure at key overhead resistance level. RSI rolling over there. And not pictured a bunch of underlying risks. Okay. Also, I noticed that if one drew a trend line, boom, it just hit the top of the trend line right there. Short squeeze. 2022. Major driver of the last leg up was a short covering. Conceptually, this is a key reason why bear market rallies are often sharp and substantial, and virtually an inevitable feature of bear market as the market gets stretched too far in one direction, even if it ends up being the right direction. What is it? Short covering. Okay. Global equities. Give me 4-week short trading. Asset manager future positioning. Asset managers continue to run fairly light futures positioning in US equities. Not a major part of the market dollar-wise, but giving a sense of where the smarter, bigger market money is positioned. Bigger money is positioned. So the bigger money is out of the market, is what it's saying, I guess. Saying versus doing seem to be disconnected between investors saying that they're underweight bearish equities versus actual equity fund flows. In other words, normally you would have expected to see large outflow from equities, not this time, not for now at least. Inflows in dark blue, allocation to equities has gone down, inflow to equities. So the inflow has slowed, but not by much. But the allocation, however that's gauged, has really dropped. Okay. Saying versus doing, part 2. On a similar vein, this chart attempts to amalgamate a bunch of different data where I've observed the same pattern. Investors say they're extreme bearish in surveys, but still have relatively high portfolio allocation in equities and are still running elevated leverage positions. And so the key question is, were they just being overly dramatic, or is there more selling, deleveraging incoming? Well, I think based on the action today, I think we're looking to get back to the old July lows, right? Still bull on that hand. As is excellent Mark Ungevutter suggests or highlights of the chart, June 2022 was a cyclical bottom. As increasingly evidenced, it's not out of character of secular trends since March 2019. 2022 was a cyclical bottom. Okay, so still long-term bull market, still in effect since 2009, according to these trend lines. Yeah, okay. Trustee thrusts. Looking at the incidence of momentum thrust with breadth trust, is what happened. It seems like the worst case based on 8 samples across a 40-year period is basically a benign, boring range, with a slight upward drift, example, the early 90s. Okay, momentum thrust with breadth trust. So here we've got momentum thrust with breadth thrust. Momentum thrust without. So whenever you get a momentum thrust with the breadth thrust, okay, what transpires over it afterwards is an up market, sideways, an upward sideways market. Okay. Yeah, sometimes you got to, okay, yeah, that's what it's saying, correct. Social media stock dilemma. Social media stocks peaked basically right about the time of the release of docudrama, The Social Dilemma. Also intriguing is that much of the underperformed social media stocks has come as pandemic reopening, release folks back to the wild. Less need for artificial human interaction. Isn't that interesting? All right. Bankers and earnings. If you ask Wall Street bank stock analysts, they will tell you earnings are going to go up. But if you ask Main Street bank loan officers, they will tell you very different prognosis. Tightening of lending standards by commercial banks is pointing to a contraction in earnings. Basically, banks are taking precautions. Okay, we know that. Buybacks versus capex. Why invest for long term when you can just give shareholders what they want short term? Now there's a bit of nuance to this because buybacks are just another way of returning cash to shareholders, the other being dividend. This can reflect a reality that companies can't find profitable enough capex opportunities versus simply returning cash. But it does, to a certain degree, also highlight some of the potential distortions to corporate behavior from being a listed company. Company captured to the short term, instant gratification, hyperactivity. of investor analysts in public markets. Bonus chart. This one's great. I've seen this before. Emerging markets versus US equities. This one is a heck of a round trip in relative performance for emerging markets versus the S&P. So the emerging markets are back to where they were in 1998 versus the S&P. In valuation terms, one versus the other. Incredible. Emerging markets outperformed the S&P some 4 times over the 10-year period from 2000 to 2010. That's this period here. I need to give it all in the subsequent 10 years. It's interesting to look back and reflect on these periods. I would say one thing that does kind of help, and that's valuations. At the extreme around the peak of the dot-com bubble, EM traded at 80% discount versus the US. Fast forward at the peak of EM frenzy, EM traded about 30% premium. As I'm writing, EM is trading about a 50 to 60% discount. Not as extreme at 80%. That's a major discount. Well, there you go. Great. I love charts. I love it. Picture says 1,000 words. Hope you enjoyed that, guys. Take a look at our mini LinkedIn groups down below. They're investment focused, and be sure to join them. And please contribute to the groups. Greg Silverman out for now.